Hello, everyone. Thanks for coming. I hope you're looking forward to a very exciting set of presentations. And the first person we're going to hear from, it's a big honor, is Sean Belka, head of Fidelity Labs. And we're really excited to hear about your innovation there.
Great. Thanks very much. So my name is Sean Belka, and I'm here to talk about how we try to incubate new businesses here at Fidelity Labs. And if I could have the clicker here, I'm going to get going in terms of slides here. Thank you very much. So the title of this presentation is really how we use financial incentives, but it's really much more about how we create alignment with our business units. I'm part of Fidelity Investments. Our mission is really to drive growth in Fidelity Labs, but with the true north mission of Fidelity Investments, which is how do we inspire better futures and outcomes for the customers and businesses that we serve. And that really is our true north in terms of when we look for new business incubation ideas, they're very much within that mission. Our group's about 150 people. We have 6 incubators going right now. And the goal is to have a continuous stream of new businesses that go into our business units or become standalone businesses. So I joined Fidelity in our venture capital group in 1993, worked in our consumer business as head of strategy and digital, and that's when I started Fidelity Labs in 2005. It was the beginning of our agile journey. We needed a place to do public experiments. We needed a place to really be able to kind of continue to get public testing. And that phase of utilizing Fidelity Labs as kind of an experience incubator continued for a few years, then kind of merged or morphed into a product incubator. And it's only the last 2 years that we've been focusing on creating whole new businesses that are adjacent to our core businesses. So the focus is growth. So we're not about innovation, we're about growth. So we have a pipeline approach to really working with our internal consulting group to screen hundreds of ideas. We try to have 10 opportunities that are always on deck. Currently, we have 6 internal startups that are live, 3 are in market, 3 are in development. And most importantly, but not on the slide, over the last year, we transitioned 2 to our business unit. So the real metric here is, are we having impact at scale? Are we creating growth for Fidelity? And are we delivering on the mission of Fidelity? I'm going to use one program to illustrate that. That's our student debt program. This is basically a way to modernize benefits so employers are able to provide help paying off student loans for their employees as a benefit that typically appeals to millennials. We started this in February of 2017. We brought it to market and pilot in September. We piloted through the end of the year, and we've now transitioned it to our business unit. So this is kind of our new model. How can we get things rapidly into market, pilot, and then transition? Because our business units are awesome at scaling. And so once we can get it over there, it has the best opportunity to really get to be a big business and to make a big difference. Secrets of our success, we're still a couple years in, so this is kind of a notional idea about what we think works. Part of it is funding. We fund the de-risking part of the business. So the initial understanding of whether there's an opportunity here, how we might go to market, and that is funded at a corporate level and through strategic investment funding. And that really de-risks it for the business unit because they have an opportunity to see if it's going to work without having to put a lot of resources into it. First-hand empathy, a big part of our methodology is around design thinking, and that is for all stakeholders. So are the business units happy where they're heading? Are the customers happy? Are all the other constituencies? And that continues throughout the process. And then scale metrics. In the beginning phase, we have very much startup metrics around milestone delivery. Are we able to bring a prototype? Are we able to take it to market? And then they switch to, are we able to get a first customer? Are we able to grow from that? So what we try to do is think through what the end game is, but start very small and really go forward as appropriate. And then lastly, most of our internal startups go towards a business unit as their inevitable home. So it's really about engaging those business units very early, making sure we stay aligned with them, and making sure as things change, they're totally in line with what we're doing. So when it migrates over to them, and typically the team will come over and the core technology and all the other things, it's just a very smooth transition. There's no surprises. It's just exactly what they expected. They saw it all along. In terms of missteps, we're doing startups in various areas, and some of them require more domain expertise than others. We've typically had a best available athlete type of model, and so what we've learned is some areas require more domain expertise than others, and it's important to get those people on the team early. And then separately, we have businesses that are B2C, B2B, B2B2C. Each of them has a different sales cycle. Each of them has a different customer acquisition journey. And we've really learned that aligning that, the expectations around that with the actual sales cycle is super important to set expectations for everyone. In terms of our future state, as I said, we've really morphed from the experiences to products. So our real goal is to create standalone new business lines that extend the core of Fidelity, take it into new areas where we can have impact, and are certainly not something that's already in the core. So there's a real focus here of the core does what it does, transformational is another part of Fidelity. We're very clearly in that adjacent space, creating new business lines. And then what we want is our business units to count on us. We want to have a repeatable, scalable model. So if we start something and get to a certain phase, they can count on us to do it. And they can also count on us, hopefully, to get better, faster each time we do it. So we're learning as Fidelity Labs, and each individual startup can be relied upon to deliver what we said it would. So with that, I'd like to invite Melissa back on stage to do Q&A.
Great. Nice. Thank you.
Thank you. Sorry.
So I was listening to your talk, and I talked to you a little bit before, and I know that the student debt program took about 3 years, I think, from start to finish. Is that a typical project cycle time for you, or shorter, longer?
What we had been looking at student debt for a while, when we really went to the build phase, it took us about a year from build to transition. So I think what we do is we kind of wait for the right time. We have a process for evaluating opportunity spaces. We try not to start with an idea. We try to bump it up a level. And so we look at opportunity spaces. In that space, we were looking at the impact of debt on millennials getting on with their adult life. Was it, stopping them from investing for their retirement, from buying homes, from doing other things? And so there was kind of an exploratory period that preceded kind of the real build period.
Okay, so you're saying that maybe it wasn't exactly 3 years. There was sort of some preamble that created that length.
Exactly.
So most of your projects are shorter?
Well, we're trying to figure that out. I said we're a couple years into this. So, our thought is that there will always be an exploratory phase, and that could, because a big part of what we're trying to do is launch things at the right time when they're ready to go to scale. So we look at the nascent aspect of a market. Too early is the same as being wrong. Too late is also an issue. So there's a timing aspect to this. So with student loan as an employee benefit, it's still a new and evolving category. So we're trying to pick the right time and really understand what's their market receptivity. Was this something that plan sponsors or employers were willing to buy? Had the issue of student loan risen up to the level of importance in their recruiting and retention efforts that we really felt we could scale a business there?
Okay, all right. You also mentioned that you have a pipeline of projects, and I was wondering how you manage your portfolio overall. Are you looking to have a certain number of radical breakthrough projects and some more derivative projects, or are you not even thinking about that sort of balanced portfolio approach? What guides you in the selection of projects that you're going to move forward?
We do look at a portfolio approach, and I don't think our portfolio is small enough that I don't think we have some ideal construct for it, but we look at portfolios in terms of risk. So to your point, is it kind of riskier in terms of market receptivity or less risky? We look at it in terms of alignment with business unit strategy, so kind of adjacency. How adjacent is it, a product adjacency or market adjacency? We look at it in terms of stage, so we're always trying to have a full pipeline, things in the early stages and things in pilot and launching. And we also look at it in terms of the opportunity for where it might head. Is it going to go to a particular business unit or to a NewCo? Our business units can probably accept 2 of these a year from us. So we have 4 major business units. We want to make sure that we're not sending too many one way and none another way, just so that we can get kind of full capacity in the system.
So I'm going to ask a clarifying question on that. You mentioned that you're looking at risk and you're looking at adjacency. Are you shooting for an optimal level of risk and adjacency, or are you trying to have projects, some of which are more risky and some are less risky, some of which are more adjacent, some of which are less adjacent?
I think what we've tried to do, and we have these multiple views, is more of as a management tool as opposed to we have an ideal version of what it should be. I think if we had larger numbers, we'd start to talk about where we're driving portfolio theory here. Obviously at Fidelity, we're very familiar with portfolio theory, but I think when you have 6 at a time, it tends to be a little bit more, what is the market ready for, both the internal market and external, as opposed to let's have some idealized version of what this portfolio should be. But it is something that we look at all the time, and when we're looking at new opportunity spaces, we look at the current portfolio and say, do we need some balance there? Do we have something that's not in a market focus that we wanted to have? Do we have something that's not in a business unit? So it's more of a management tool to understand how we might add to the portfolio, as opposed to we know what an optimal portfolio looks like and we constantly have it.
So what if you end up with a great project where it's not obvious how this is going to fit into one of your existing business lines? Does that mean you're not going to take it?
No, so we have one right now. It becomes a NewCo. So I think we have business units, and those are obviously the clearest path to scaling because they have a lot of distribution, and they have amazing customer relationships, and they have wildly skilled people in those business units who know how to bring things to market in a powerful way. But we have one right now where it's kind of between two business units, and so we're bringing it to market ourselves. So we've created a go-to-market function in Fidelity Labs, and we're bringing that to market on our own. And obviously that's a tougher path because we don't have the built-in distribution of a business unit, but at the same time it gives us the opportunity to extend Fidelity's reach into a market segment we're not currently in.
Yeah. Plus, I imagine those projects can evolve their own culture, and so to become a new company for them is probably easier than getting integrated into a business line that has an existing culture.
And so we're really fortunate that the way our businesses are organized is kind of large-scale agile. So, one of our internal startups can kind of go into a business unit almost as an intact tribe into a business unit. So it is an easier path than if they were functionally oriented, where you'd have to break up the team and put someone in marketing, someone in product, someone in technology. So we're very fortunate that that's how we're organized writ large. But the NewCo is a great option for us because particularly if we're trying to do new market segments, we might not always have a business unit who's covering that segment.
Right, I love that phrase you used, intact tribe. So these business units, they can often keep a project team together and relatively autonomous.
Correct.
That's great.
Yeah.
Awesome. We have a bunch of questions here that we got from the audience earlier. I'm going to pick some of them to ask you. How many pilots do you have running at any given time, and how do they compare to the size of your debt product program?
So we have 3 in pilot right now, and again, it varies depending on the launch schedules. I think we could probably handle a couple more, and we have a couple that are going to go into pilot early in 2019. In terms of the debt program, some are larger and some are smaller. I mean, that market is an evolving market. We'll see. We believe that student loans are a very important aspect of people's financial lives, and that employers are going to want to help their associates with that. But at the same time, there are other aspects of their financial lives that they need help with too. So we're fortunate that the categories we play in, whether it's employee benefits or personal finance, are very large categories. So the market size is typically something that is there inherently, and we're really not going after niche businesses. We're trying to do things that have impact at scale.
That's cool. I teach innovation strategy at Stern, and when students come to my class, they've already learned NPV, cash flow models, and they tend to assume that any project that they can get a positive NPV on is going to be supported by the organization. But I found that, in fact, most of the time organizations have a finite R&D budget, and they're rank ordering projects, and they're spending that money until they run out of projects. Would you say, what is sort of the scenario at Fidelity? If you see more projects than your budget would normally support, are they going to expand the budget, or are you basically funding projects up to a finite budget?
So I think we do have a strategic investment fund that has a number, but I think we're very opportunistic, and if there's a great opportunity, we're going to go after it. And we've seen that this year where we've gone, quote unquote, above our budget, but it was because we thought there were compelling opportunities.
Okay.
I think to your point, the financial returns are an aspect of it, but in many ways, our mission around really being able to help people improve financial lives, there's a strategic aspect to this, and there's an alignment with what our business unit strategies are. So if it was a pure financial return, but it wasn't strategic aligned or wasn't mission aligned, it wouldn't be interesting to us. And so at the same time, if it's all three, it really has a compelling business case. It helps us deliver on our mission, and there's a business unit that's excited about bringing it to market. We'll find a way to fund that. That's
really interesting. So that's another issue with students. They often assume that projects are being chosen strictly on financial criteria, and yet don't you find a lot of times that if somebody wants a project, they're just going to make the financial criteria look positive. So in a way, financial criteria, I always tell the students, can be a little bit like a wolf in sheep's clothing, because really it's strategic, qualitative criteria that are probably more important for selecting a project, like how it fits with your plan for the future or the firm's capabilities.
And I think there's a difference between operating in the core and operating in the space we do. When I was in the core, most of your business cases are incremental. there's a relatively stable base of assumptions you have, and the financial return is relatively predictable. When the spaces we're in, it's much more akin to a startup, and so to put a lot of credence in someone saying what a 5-year IRR is going to be on something you don't have started and you don't even have one customer, I think we have kind of a realism at Fidelity, because we're an investment firm, that, hey, that's really not appropriate here. What's appropriate at this stage is really, can you get a first customer? Can you get something to market? Do customers love it? Is it something you see as resonating? And we try to also allocate the funding as you might think about, almost like a seed round, an A round, a B round. So it's not, here's a huge check, we'll see in 5 years. It's like, here's a small check, assemble a team, get a prototype to market, get customer feedback, come back for a next check and a next check. And so there's a way to manage that risk along the way. So when you're going to scale, you now have had months in customer and market, you understand the unit economics, you understand the cost of acquisition. You're now in a place to be able to put together a credible business plan. At the start, when you just have an idea or an opportunity space, you're not. And so we try to be realistic about what is feasible and realistic here, and what is required here when you're going to write a bigger check. And not, I think what I have observed over time is sometimes businesses that are used to operating in a core, mature, stable environment will take this type of approach to an early stage thing. And that's when you end up with financials that are probably not super useful in terms of really understanding what the opportunity is.
Okay, great. I'll take another question here that we got from the audience. It says that you've been in the lab for about more than 10 years, and serving as one of its original founders back in 2006. So there have been a lot of folks in the room who might want to embark on something similar. What would you say are the 1 or 2 strategies or tactics that you've done that you would say others should consider doing? Or what are the 1 or 2 things you wish you'd avoided, things that you know now that you wouldn't do again?
I mean, I think I would say 2 things. I mean, it's people over process. I mean, Anand made some jokes about everyone working on your stage gates, and we do have one, and it's important that we understand what we're expecting from people at various points in the process. But in many ways, the key to our success is talent. Do we have people that have a unique combination of, they have entrepreneurial abilities, they probably worked at a startup, and at the same time, they know how to operate in a big company environment. And so those people typically do not from our core business. And they're typically people, if they worked at a startup, they also worked at a big firm or a consulting firm. So that's super important. It's all about talent when you're starting with a blank sheet of paper. The second thing is business unit alignment. I think disruption is a big word and all the other stuff. I mean, we are not trying to disrupt our business units. We're trying to extend their businesses. So our goal is to make sure that we understand their roadmaps, the markets they care about, and that we're advancing the ball for them down that kind of field. And so it's important to both have people that are credible to business units, but are also listening deeply and understanding what the needs are. Now, there's another part of Fidelity that's thinking about kind of, if you want to talk about Horizon 3 or other things like that, our job is really just to extend into adjacent spaces. So it's the alignment, and people are the key aspects of that.
So it sounds like because you're really serving these business units, you're going to be pulled more in the direction of incremental innovation. Is that true?
Well, incremental, the way we would define incremental is it already exists and you're improving it.
Okay.
We are not doing that.
All right.
Ours is adjacent, and we wouldn't call it innovation, we call it growth, but the idea being we're not in that business, but we have advantages to get into that business, and so we should do it, as opposed to if we're Fidelity and we decided to go into organic foods, like we probably wouldn't have a clear advantage there, but if we're a benefits provider and we decide to offer student loans as a benefit, that is a new business line. It's all incremental revenue to that business unit. It's a brand new, product set. It's a brand new way to serve customers. It did not exist before. So in our mind, incremental is, it would be like improving the 401k is now what we do. That's what our core business would do. Starting a new business line for them that they can then manage is what we do.
Okay, so I'm going to ask you a tougher question, and you might not be able to answer it because it might be too early in the life cycle of your program here, but have you ever had to kill a project that had really gotten underway and maybe gotten at least a year in? Have you gotten to a point where you had to kill that, and how did you make that decision?
And I think one of the things we've learned is it's less about killing it. Sometimes we have transitioned things to a business unit without a team and without the momentum, and it's not so much that it got killed, it just kind of lingered. It didn't really
became a zombie
move.
project?
Yeah, a little bit, yeah. And so I think, so I think that's been more the learning, is that if you're not going to send something into a business unit with a fully intact team with momentum, that the big risk is not that so much that it's killed, it's just that it doesn't realize its promise. It becomes kind of a zombie, and that's it. Where we try to kill projects, and we kill them all the time, is in the early stages.
Oh.
So, we kill them at the idea. We have our process we call fast, but we assess: is there a real job to be done? Is it an important job to be done? Do a lot of people have this job to be done? And are there good alternatives? A lot of things die there. We conclude that someone had an idea, but there's no really burning need. And in financial services in particular, inertia is a big deal. So if you're not really solving an important problem with a really compelling solution, people are probably just going to keep doing what they're doing. So we try to make the bar high there around, is this really an important job you've done? Is this really a big problem for people? Many things die there. The next phase is really about, can we find product market fit in a test environment? And then things may die there. We may conclude, yes, there's an important job to be done. We can't figure out how to solve it. So what we try to do is have things die earlier, cheaper, and kind of in a kind of test environment, not fail after they've been launched. Failing at scale is not what we want to do.
Okay, cool. So the audience wants to know, you get to decide whether something's overrated or underrated.
Okay.
And the first one is robo-advisors. Overrated or underrated?
Well, we have Fidelity Go, which is an amazing robo-advisor, and I think Fidelity Go is underrated.
Underrated, okay. What about artificial intelligence?
I mean, again, artificial intelligence has been around for 60 years, and I think it's one of these things where we've had winters and kind of springs in artificial intelligence, and I think for now it's real. And I think, so in some ways, I think it's underrated in the sense that I think it's going to permeate a lot of aspects of our life.
And probably already is.
Yes.
I'm a robot right now.
Exactly.
Overrated or underrated? Corporate accelerators.
Well, it's a word that means a lot of different things to different people. So in our case, we're very focused on incubating new businesses that we're going to wholly own and operate. In other cases, it can mean bringing in startups for a couple weeks and other stuff. So I think it lacks definition. So I will say it is neutrally rated because it depends what it is.
All right, that sounds like a dodge, but I'll take it. What about overrated or underrated? Blockchain.
I think it's too early to tell. So, I mean, we obviously have made some announcements in this space in terms of crypto custodying and have been looking at blockchain for a while. And I think it's a nascent technology that has the potential to really do some amazing stuff. But I think now the people who are confident that it's under or overrated probably have better predictive powers than I do. Okay,
cool. And the last one here, which is similar to corporate accelerators, corporate venture capital arms.
Yeah, I think, again, and there's been a lot of discussion about what is the purpose of that. So at Fidelity, we have venture capital arms that are purely financial return. We have some that help us to work with partners where if we're going to help them to grow, we're going to invest in them because we want to share in our mutual success. So I think similar to the corporate accelerators, it's a broad category. It's hard to generalize, but I think when done right, they provide an opportunity for large firms to work with startups in a way that's great for both, gives them capital that they need, gives them access to distribution, and gives the large company an ability to participate in their growth. So I think done right, they are probably underrated.
Okay, underrated. Well, we are actually out of time, so thank you so much for joining us.
My pleasure.